Hi everyone, it is your investing coach Wahidah here. This is where you can learn how to invest and build generational wealth, even if you are the first in your family to do so. Today we are going to be talking about how the majority of active fund managers are not beating the market and how we can focus in on investing within index funds to passively invest and know that we are actually doing better than the majority of professionals who are managing portfolios. Okay, so there's been studies done by S&P Go Global, and I'll link the studies in the description, but they have found that in 2021, 85% of active fund managers investing in the large cap domestic equity mutual fund actually underperformed the S&P 500. So let's go back and digest what this means. Active fund managers are essentially professionals who are actively looking at their portfolio. They're looking at what assets to buy, what assets to sell, what assets to hold. So they're essentially in it day in, day out. The large cap domestic equity mutual fund. So let's break down what a mutual fund is. A mutual fund is essentially a pool of assets. And then the large cap domestic equity part is essentially saying what kind of assets that pool consists of. And the large cap domestic equity mutual fund is essentially a pool of assets that contain the largest companies within the US. And then the S&P 500 is essentially an index where it's just tracking the largest 500 companies within the US at any given time. So in this graphic, you can see that in 2021, 85% of active fund managers who are investing in the large cap domestic equity mutual funds actually underperformed the S&P 500. And you can see over the last 20 years, the majority of active managers who are investing within these equity funds were underperforming the S&P 500. What does this mean? In my other videos, I do talk about index funds, and index funds are essentially just buying what is in the index. So remember when I mentioned the S&P 500 index is just tracking the largest 500 companies within the US. An index fund can now say, okay, I'm gonna just buy whatever the index that I'm tracking is. So the S&P 500 index fund is just buying the companies that the S&P 500 index is tracking. So there's no calculations that you have to do on your part or think about which companies do I want to buy or not buy. All you have to do is put your money in an index fund and it buys what's in the S&P 500 or whatever index you're tracking. And we can see that if we were to invest within the S&P 500 last year, that index fund would have done better than 85% of the active managers who were investing within the large cap domestic equity mutual funds. Wild, right? Wild. So don't think like, oh, I don't know how to do this. I don't know anything about stocks or bonds or investments. You don't need to. You don't need to. And it turns out that the people that say they do know about these things are actually not doing that great. So we can invest within the index funds, and know that we're doing a lot better than a lot of these other active fund managers. Okay, so one thing that also really affects your returns are fees. Because if you're in an actively managed fund, you are now essentially having to pay that person to manage those funds. And there's gonna be management fees connected to that. And that can really eat away at your returns, at the growth within your investments. So that's one thing you want to really keep in mind if you're wanting to go with an active fund manager, is how much they're charging. Okay, so in this next graph, you can see how much fees can really affect your returns. So this graph is looking at how fees can eat away at investment returns, and they're looking at two different things. They're looking at institutional accounts and they're looking at mutual funds before fees are taken out, gross of fees, and then after fees are taken out. So net of fees. So really quickly, institutional accounts, what are they? Institutional accounts essentially serve like organizations, corporations, like governments, foundations. So they're like institutional accounts and mutual funds are similar. It just the big difference is where the money is coming from. Institutional accounts have like a few hundred investors with large amounts of money coming together. And they're managing that for the different like fund, foundation, endowment, government, whatever. And then mutual funds are more for retail investors like me and you. So more like the everyday investor, right? So we have smaller amounts to invest, but within the mutual funds, there's like millions of individuals pooling their money together. So funds, so different assets can be bought within that mutual fund. So anyways, this is just to say that both institutional accounts and mutual funds are actively managed. So in the next graph, you're going to see how much fees can really affect your returns. The graph is essentially looking at institutional accounts and mutual funds before fees. So gross of fees and net of fees after fees. So within this graph, you can see, so we're gonna now go into let's go look at the large cap funds again, just to be consistent. So you can see over the 10 years on average, both the institutional accounts and the mutual funds underperformed all of their benchmarks. So if you look at all the large cap funds, their benchmarks would be the S&P 500. So looking at this graph, you can see that over the 10-year span, on average, both the institutional accounts and the mutual funds all underperformed their benchmarks. And we talked about fees, right? So that means we're paying an active fund manager to invest our money, but then they're underperforming the market. So let's take a closer look. Let's look at the all large cap funds. Their benchmark would be the S&P 500. So this is similar to the graph that we were comparing earlier. So looking at the all large cap funds, you can see over the 10-year span, 78% of institutional accounts, and similar for the mutual funds, looks like they're comparable. 78% of institutional accounts and 78% of mutual funds underperformed the market. This is before fees are taken out, so gross of fees. And then if we're looking at how they compared after taking out the fees, the percentage jumps to 83% of the institutional accounts and the mutual funds. So you can see that's a 5% jump up. Now they're underperforming even more because before fees, they did okay. Well, they didn't beat the market, but now they have to add their fees because they did work. So now they're taking a payment, and now which means it takes away from your returns. So now, if you're looking at how these active fund managers did after fees, so net of fees, they did even worse compared to their benchmark. So before fees, all large cap funds, for institutional mutual funds, they were underperforming over the last 10 years, so from 2011 through 2021. So over those last 10 years span, 78% underperformed the market before fees, and then after fees, 85% of these active fund managers underperformed the market. Wild. This is wild. This is to say that most actively managed mutual funds are not beating the market. So instead of trying to beat the market, just invest in the market, right? So we just want to match the market returns. And we can do this actually quite easily through index funds. So watch some of my other videos on index funds to get a better understanding of what these are. And some of sample index funds that you can invest in that would track some of the popular benchmarks that we're looking at. And again, you don't need to understand a whole lot about investing. You don't need to understand too much about like what's the stock, the bond, all these intricacies. It shouldn't be a roadblock to you to get invested, because look, we just literally looked at these studies, and it shows that over the span of a long period, these active fund managers aren't beating the market. They're not doing any better than if you would have invested in these index funds. They're doing quite worse, actually. So don't try to beat the market, especially if you're not an expert in it. Just invest in the market, in the total market. All right, everyone, thanks so much for joining me today. And I just want to also say that this information is not investment advice. It's really for you to get a better understanding of what the different things that are happening in the investment world, so you have a better knowledge base. If you're needing more personalized information, this is when you can reach out to professionals like certified financial planners, so you can talk more about what your situations entails. All right, everyone, see you next time. Bye.